Hey guys, Stoney here, and I'm just going to give you guys a breakdown on what I consider equity curve and what equity curve is. So equity curve is generally it's just the trail that your trading creates in your profit. So when you trade, your equity curve is going to be based off of your trade plan. So your equity curve would be based off of trade plan. And all this means is your trade plan will give you what your equity curve is. And how's it going to do that? It's going to do that through a series of trades. So the idea behind an equity curve is you do not want to mess up what your equity curve is. If you have a tested strategy that you've traded multiple times, you're going to get somewhat of an equity curve. An equity curve can look like anything, but over the course of a month, you want something along the lines of this, or maybe even farther straight up. This would be your drawdown phases right here. And these happen, but they're to be expected in any plan. What we're trying to avoid is this. Usually what we get is we get highest point our account's ever gone, lowest point our account's ever gone. Even higher point, huge. We want to avoid these gigantic drawdown phases. And that's what we are watching when we watch for our equity curve to play out. So the way that I run my equity curve and the way that I have to think about it goes in terms of RR always. So going in terms of RR, we want a trade plan that's going to give us a strong RR. That's something of a 1 to 3 or higher. If we're not getting a 1 to 3 or higher, it's generally not a move we want to build. And the way it works out, so that trade plan, the way it's going to work out and the reason RR is important is if you think of a trade plan that has 1 to 3 RR. So my trade plan, whatever trade plan you're looking at, I'll go off of mine just using average numbers. So my trade plan on average gives about 3.2 RR. My average win is about 40%. Wins would be any target, any trade that hits target, not just a trade that ends profitable. So my average win percent is 40%, but I do have break-even trades that will change that number. So that's why you need to go off of RR, because those break-even trades do affect your RR, because your RR is how much money you lose compared to how much money you win. So if you're looking at a short-term RR, you might see maybe I'll have like a 12 or a 9 RR in a week, but it's only because I broke even on a few trades and had a bunch of winners. That doesn't necessarily mean I'm not aiming for a 3 to 2 every trade. My average RR per trade runs between 3.8 to 4.5, anywhere inside there. So it's lowered based on my break-even attempts and the losses I do take. So just based on this average RR with an average win rate of 40%, let's just map out a couple of trades. So let's say trade 1. We lost 1%. We know that our risk, which also should be in your trade plan, is your risk. My risk is actually 2% a trade, but I have a structure that I use when I'm TPing. So rather than going into that, I'm going to just keep it simple and say 1% risk. So we're going to change this to a blue color for our trade plan. So trade 1, let's say paid out -1%. Let's say trade 2 paid out the same. And trade 3 played out the same. So right now you've taken 3 trades. You are at 3% loss on your account. Now 1 win for me comes in. I hit my 3%. So now we're flat. So here we've just gone flat on the account. So that 1 tells you, again, why you must trust your RR. So we're flat right here at trade 4 with the account. Now taking a second win, we're going to run to trade 5 at 3%. Trade 6 could be a break even, so we'll put 0%. Trade 7, we lost 1%. Trade 8, we lost 1%. And trade 9, we broke even. And trade 10, we won. Let's say on trade 10, we let our trade run a little bit farther, which gave us that 4, which is how you're going to equal out those average wins. So just adding up the numbers we had, we went from -3 to flat to +3 to +1 to flat to +5. So this trading plan with an average RR, an average risk, an average win rate based on the trade plan I've already have written. So I've tested these trades. So I know what my numbers are based on what I've resolved. FTMO has a journal feature. You can use that. MyFX book has a journal feature. Awanda has a journal feature. There's a tons of ways you can track this, and you can track it through your own trading. But what's important is you have enough data, not just one decent week, because the market has bad weeks and has good weeks. So you need more data to make this number more correct. Do not run this off of 20 trades. Run this off of 3 months minimum of trades that you've taken on an account, and that's how you're going to get it. So results. So we know we came away with -3, flat, 3 up, 1 up, 5 up. So we know we came across with a profit of 5%, a win rate of loss, 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 win. We won 2. We won 3 trades out of this. That is 30% win rate. I do not add my break evens as wins, because wins is when it reaches target for me. Risk was 1% per trade. And our average RR, we see that we hit 3 to 1, 3 to 1, and 4 to 1. So knowing that's our numbers, our average RR is going to be above 3%, because we usually lose 1% on every single trade. With these 2 wins, these 3 wins take our positive swing of our RR. So it's going to be above a 3 because we have this 4% win. And our average loss is going to be below -1 because we have these break-even trades. So our average RR is anywhere between, I would say, 3.5 to 4%. I would even range to say it's higher than that, or 3.5 to 4. I wouldn't use a percentage. So, and this is where the point of the equity curve comes in. So just drawing out the equity curve on the trade we just have taken, we know that we took 3 losses. We got a win that evened us out. And then after that win, we got another win that doubled us up. We stayed flat. We took 2 more losses. We stayed flat. And we got another one that took us up. These are the drawdown phases that you want to be in. Very short, much longer. Very short, much longer. Unlike if we would have changed anything, if we would have taken this trade at reduced. So you take this trade at reduced, and let's say that you decided you wanted to let your ego take your trades a little bit. Let's say on this last trade, you took half of the gain because you were down and you wanted to catch back up. Let's say on this third win, you lost 1.5% rather than 1 because you over leveraged a little bit. Let's say on trade 6, you held when you shouldn't have, and you lost 1% on a flat trade. And let's say trade 8, again, you over leveraged just a teeny bit to 1.2. So let's see what this did with our numbers now that we messed everything up. I'm going to use a calculator for this. So we lost 3.5%, so negative 3.5%. On trade 4, we won 3, and then we won 3 also on here. So we're going to add 3, and then we're here. Trade 6, that was a flat that we took a loss on. So -1, -2, -3.2. Trade 9 was still flat, and our last trade was only 2% instead of 3. So we add 2. We only made 1.3% on that adjusted curve, right? So instead of having this result of 5%, just taking a few minor mental changes that adjusted your whole trade plan to a 1.2%. So you got 1.2% on your move rather than what it could have been, which is 5%. I call the difference between those 2 points emotional slippage, and this is something I always put in my journal. Emotional slippage occurs whenever you let yourself adjust your trading plan based on fear, based on greed, based on any of the emotions that come into us. And now we know that if we had messed up our equity curve, which is based off our trade plan, which adjusted our strong RR, our trade plan would look more like this. We would lose 3% here, just like we did in the first run, except we lose a little bit more on the last one. So we make 3 back, but we wouldn't make back that 0.5%. We make another 3 back, but we wouldn't exactly get to the highs we were before. We would lose 1, 2, 3 on the account, and then we would only make back 2% from there. So this is why the issue is that we get that 1.2% rather than that 5%, because we're not adjusting our trade plan. Same length as this, same length as this. Your equity curve needs to be thin so you can have a positive equity curve. You don't want an equity curve that lags like this. It's going to take a lot longer. And depending on how emotional you are, what's your mind state during these bottoms? Are you over leveraging during these bottoms and is creating more risks? Are you under leveraging during these bottoms and is creating additional risk? These are things you need to look at, especially when you are building a trade plan. Guys, this may seem boring, but this is system building. So if you want to be a trader, this is the way you have to think. This is a job. We come to work and we follow our trade plan. Our trade plan equals our equity curve. Our equity curve equals our results. We want this result. We have to follow this trade plan. So don't shoot yourself in the foot. That's all I got for you today. If you have any questions, comment below or shoot me a message on Instagram. You can also sign up for any services on sonyfinancial.com. Thanks, guys.